Good morning. Today is Friday, December 9th. I'm Joe Terril, president of Terril and Company, independent wealth managers headquartered in St. Louis, Missouri. This is another video update on our thoughts on the economy and investment markets. Before starting, let me take the opportunity to wish all of our viewers the very best for a happy holiday season and a healthy holiday season to you and your families. We are once again in a tug of war with investment markets as to what will be the results of the economy in the next 6 months as central bankers all over the world continue to increase interest rates. In the United States, the Federal Reserve Bank next week is almost certain to raise interest rates at least another 50 basis points. Around the world, inflation is actually running at a higher rate than it is in the United States. Terril and Company, and our belief is in the camp that this inflation is not getting ready to go down dramatically anytime soon. So in other words, if our inflation that topped out maybe somewhere around 9.5%, recently been running at 7.5%, if it falls to 5.5%, 6%, it's down, but that is still too high and will not give the Fed any margin to stop increasing interest rates, or, as some people actually believe, cut interest rates. This morning we saw the producer price index come out and it was higher than people expected. This inflation that we continue to see running higher is being led by higher wages. Delta pilots, in a very public scenario earlier this week, got a 31% increase in pay. Railroad workers look like it's going to be a 25% increase in pay. That is inflation in the services side. You also see higher insurance cost. You see higher repairs and maintenance cost. These things are going to carry inflation. It's not just the price of gasoline. Yes, that's down, but that doesn't mean inflation's getting ready to crash, go back to 2%, which will lead the Fed to begin to cut interest rates. Employment is very strong. We have more people working right now than any time in history. This is true also around the world. There's a labor shortage. People are receiving pay increases. This is hardly the type of thing that leads you to believe we're going to have a recession soon, employment's going to go up, businesses are going to lay everybody off, and the Fed's going to lower interest rates back down. So, trying to sum this up a little bit, we see a strong economy. We see the economy continuing to do just fine. If you look at travel, hotels, restaurants, businesses booming. If you look at certain areas of the economy, consumer spending is staying very strong. It's highly unlikely businesses will cut back when the consumer has plenty of money to spend and is anxious to do it. So we see a strong economy. We see interest rates staying up at a longer time frame. The Federal Reserve Bank and governors of the Fed are telling you this, that interest rates are going to be higher for longer time frame. We believe them. The markets, to a certain extent, would tell you, oh, that's what the Federal Reserve Bank is saying, but they don't actually mean it. The first sign there's any type of downtick in the economy or uptick in unemployment, they're going to change their mind and begin to cut interest rates. Absolutely not going to happen. So put some of this together, we think investment markets are somewhat overvalued. Everyone's anxious to buy long-term bonds because they believe interest rates are going to go down and they'll have nice bond profits. Isn't going to happen. On the equity side of things, there's a misunderstanding about what created the corporate profit surge that we've seen in the last 10 years. Yes, many good companies out there selling very good products, very productive, very well managed, and that's been a big reason for the gain in corporate profits. But another part of that gain in corporate profits has been, for the last 10 to 15 years, corporations refinancing billions and billions of dollars worth of debt at lower and lower interest rates. We looked at a company here at Terril and Company last week that had about $4.5–5 billion in outstanding debt. We went back and looked 10 years ago what interest rate they were paying and did a calculation. It's about $120 million a year that's falling right to their earnings based upon just simply refinancing outstanding debt. That is about to reverse itself. When we look at all the short-term corporate bonds that we see companies that it's a 2% bond, it's a 1.25% bond, in some cases even less than 1%. When that debt comes due over the next 2 years, it's going to be refinanced north of 5%. So this cost, if you will be a drag on earnings. So we're not confident that people's projections that corporate profits are going to continue to grow at 10 and 12%. No, business is going to be good, but their cost of operating is going to be much higher, whether it's higher wages they have to pay, higher things such as their insurance cost, and certainly higher cost of capital. Even with business being good, it's going to be difficult for them to continue to grow corporate profits at those levels. So put it all together, we remain very cautious. We think fixed income needs to be very short, staying in a 6 to 9 month maturity range. And equities, we're very defensive in that area and believe that if we're patient, we'll get better buying opportunities once it becomes obvious to the market that the corporate profits are not just somehow automatically going to grow. Interest rates go down, PE ratios go up, and stocks do great. We don't see that happening. So with that said, Brian Curtis, that helps us produce these video updates, thank you. A very happy holiday season to you and your family. And we may be back right before the end of the year with another video update. If not, we'll do one right at the first of the year. Thank you.